Hello, hello, hello. Hello, everyone. Hey, Tom, how are you doing?
Fine, thank you. Good morning, Vivek.
Okay, one second. How do I make it not switch my output? Say it again. Hopefully now I'll be able to hear you.
Good morning, Vivek. Thanks for hosting another meeting.
Hold on, hold on. Damn it. One second. I still can't hear.
Hello, hello, hello.
Oh,
One,
now I
two,
can hear.
three. Hello,
Yes,
hello,
yes,
hello.
sir. Thank you. Thank you for helping me with this whole sound test.
Hardly any effort. Glad to be here.
Good to see you. Good to see you.
Likewise. How'd you make out last week?
Hey, you know what? I was okay. So we had our kids' graduation on Friday.
Oh,
So
nice.
so we had to leave at like 8 o'clock Pacific time. And then morning I'm like, oh, market is like down. It was like fluctuating between maybe down 2%, 1.5%. I was like, oh, it's okay. 2% down, who cares? By the time we were done with all the ceremony and all that, around 12:30, pictures, and then we were discussing where to go for lunch. And then I looked at my phone. I'm like, wow, it's down 5%, especially on the tech side, right? QQQ was down a lot. Like, okay, whatever it is, who cares? Can't do much anyway. So I was like out for most of the trading day yesterday. So didn't do much, but when I came back and I was right in the evening, I was looking at the markets and to prep up for the meeting. And then I realized, okay, SPY was down almost 2.75%. And it looks like the tech was down almost 4.5%. So it is what it is. I can't help that. But hey, market is back where it was 3 weeks ago. So we haven't lost much. We lost 3 weeks of gain.
First of all, congratulations to
Thank you.
you and your wife for graduating another daughter.
Yeah, thank you. Yeah, so at least she'll be out of no, she'll be in the college. Will be.
Good, good. So, and then I like your shirt. Does it reflect your indecision on the direction of the market?
I never noticed that.
Up or
Yeah,
down, up
was
or
like a
down?
blue and red. Yeah, I never noticed that. Yeah,
All right.
yeah, yeah. Didn't notice that before. Yeah, but good observation. Maybe yeah, I should now I can say, hey, I wear this shirt because I'm generally, you know, market directional neutral. I don't care where the market goes this month or this year.
I always wear a green shirt on the last trading day of the month, just for superstition.
I I wish markets worked out that way. Anyway. Okay, who else? How are you doing? So I was away for most of the day yesterday. How did you guys do in the market? What was your feelings about it? How did you feel? What were the vibes in the market yesterday?
I think
Any
it's enough to turn me bearish.
Sherwin, market is barely like moved into we'll show that fear and greed index. We barely moved into fear and turning bearish. I think this
Yeah,
is the time when it's the time to deploy the capital when the market is like turning into fear territory. Hopefully, if you have the capital available on the side. I
I,
mean,
I'm very finicky, so I turn bearish.
yeah, okay, okay. Yeah, hard for me to turn very so quickly. I mean, individual stocks, sure, but overall market, I think I'm still hopeful. Samir says every moment I thought that was a low, it hit another low. You know, the- when the stocks that we buy go lower and the stocks that we sell, it continues to go higher. That's the life of us as an investor. He deployed cash on Friday, maybe too early. I think my thesis is we can never tell that it's too early. We can only get to know in a hindsight. So I generally have a criteria in terms of deploying it in fourths or maybe fifths. saying, hey, if the market has gone down, let's say 5% or 3%, pick up a threshold which you're comfortable with. I'm going to deploy 1/5 or 1/4 of my capital. If it goes down another 3%, maybe I'll deploy another 1/4 of a capital. So I work because I can never time the market. I don't know what the market's going to do. So I deploy or I buy, or I sell in the trenches in 1/4 or 1/3 or 1/5. Figure it out, whatever works. So that's would be me. All right. Yeah.
I had the volatility has increased and it has caused some problem, a drawdown in my account. But some of my short positions are helping out with the drawdown to some extent. The volatility is going to be increasing to some extent, and it's, in my opinion, it is not time for me to get back into the market at this point. I would just wait for a little longer and then decide when the market is down about 10% or 12% or something like that.
Sure. Yeah. Yeah. So even from over a portfolio perspective, yeah, even I'm down. I mean, I think in Sherwin's Discord, I mentioned there was an iron condor on NDX, and I'm like, maybe if I close it, gonna make $1,000. But if market doesn't fall too much on Friday, probably it'll be like almost $4,000 bet, and I held to it. What did I know on Friday? Like, not only I lost that 1,000, I probably had some other put spread which I should have closed. There is nothing new that I learned on losing money on Friday. I knew everything, but sometimes greed get better of you. I did not close some of the put spread on NDS that I had. So instead of making money on Thursday, I not only lost that, I gave up more from my pocket on Friday. Well, it is what it is. But yeah, I think we're still okay. The markets are not that bad. Pradase deployed some capital on Thursday, and on Friday market went down again. Sam said bought a few shares of Broadcom after Cathie Wood. If I were to buy Broadcom, I would buy because I like the business and I like the growth I had set to the prospects. I don't care whether Cathie Wood buys or not. Neither should you. Never ever buy because anyone else buy because I bought or Cathie Wood bought or Berkshire Hathaway bought or whoever. PK, what are your thoughts on buying TQQ and SQQQ with stop loss for Monday if you don't know which direction market will go? Also, we will talk about some leverage ETF. I don't know, is TQQ and these are leveraged or these are just the inverse ones? But I generally don't do. Today we'll basically finish the pending topic from last week to talk about some exotic ETFs, and some of these leveraged ETFs are part of that. These are tactical instruments. If we want to buy and hold it for Monday, sure. I mean, for me, it really doesn't matter unless the market goes down another 5% on Monday. I think I'll still survive. So I don't want to buy just for one day, right? And stop loss, I think that other people can talk a lot more about the stop loss and use of stop loss. I have never used stop loss in my investing/trading life. So I cannot comment on how you take the stop loss, how you move up or down, because I don't do it. SOXL down 30%. I think that's again a leverage ETF, XOSL probably. And yeah, it cut both ways. These instruments are never meant to buy and hold, especially retail investors. These instruments, let me just first check if SOXL is leveraged one or wow, it is like 3x leveraged. So yeah, so these are very tactical instruments. I just don't touch these. These are to be meant to be bought and held for maybe 6 hours, maybe max a day. And we are talking about holding for months. It's not even meant for that. So mathematically, it's very difficult to make money in these leveraged ETFs. There's so much of a drag. And maybe we'll run some simulations today. SPY is good if it's like a 4x SPY. You have to be really, really very nimble. And which, I mean, I don't want to be glued to the screen for whole day. So I don't want to buy or hold any instruments that are very short-term technical tools to manage volatility for a day or for a week. That's just not me. Many of if you are a different kind of an investor or trader, if you're a day trader, sure, these instruments may be for you. All right, so shall we get started? Anyone joining here for the first time? Let's get some intro if anyone here is the first timer here. Anyone? Last week we had a few, those who were first timers. Harshini. Harshini, why don't you go and introduce yourself? Where did you find us and what brings you here and what kind of investor are you?
Yeah, sure. Can you hear me now?
Yep.
Okay, got it. Hi, Vivek. Hi, everyone. So this is my first session here. So I found this investing group on the Meetup app, and so I'm a software engineer. I moved to the Bay Area recently from India,
Mhm.
and I started investing in the US markets recently. I would say around like 5, 6 months back only. So yeah, I'm still like in the process of like learning a lot about it, and like I wouldn't say I have a investing type. Like I try to diversify things as much as possible, but recently I've been seeing like suggestions from investors. Like this market these days is like a stock pickers markets. Only if you pick the right stocks and not buy the broader S&P, your portfolio will be increasing well because the S&P has like equal amount of winners and losers. I've been like trying to research more on stocks and the best strategies to invest because of that and not just buy into S&P 500. So that's where I'm at right now. Yeah.
Cool. Welcome. Yeah, there are different thoughts on index investing or S&P investing versus individual stocks. I have an overlay of if you are not interested in following an individual company, not following in terms of the social media post, but following through their earnings, their annual reports, listening to what they say in a conferences, then we don't have any business in owning individual stocks. We don't care. I don't care whether Berkshire Hathaway bought it or any other fund manager has bought it. If you do not have interest or time or energy to follow individual stocks, stay with ETFs. And also because these individual stocks could be a lot more volatile too. And while the folks that we're talking about probably will benefit, but you may get chickened out because you just can't withstand that volatility. So it's a very different mindset on individual stocks versus investing in ETF. Both are right. I'm not saying anything is wrong. And this is my learning over the past many years have been. And I used to think that day trading is not good or buying into this volatile GME, buying into these meme stocks is not good. But I was wrong. I realized I was wrong. I think a there is a right way to make money for every different type of investor. And my investing style is not the only investing style, right? But it works for me. Similarly, day trading probably works for a lot of people, or may not be, but it's for them, but not for me. So I think it's very important for you to identify what works for you, what kind of investor you are, and find your own game. We will never be able to win if we are playing someone else's game on especially in the market. It took a lot of time for me to figure out what my game is, and then it'll be better. You'll not get into the FOMO or greed or fear because hey, let other people buy SpaceX or SOXL or whatever, right? Pick up these thematic ETFs. You won't get the FOMO. You realize that's not your game. So That's all I have to say. Anyway, welcome. Good to have you here. Anyone else joining here for the first time before we jump into our regular session? Nope. Okay, so we got a regular crowd then. All right, let me share my screen and then we get going. Okay. Tell me, what are you guys seeing? Are you seeing stock analysis or a Word document?
Discussion 325.
Perfect. Number 325. All right, so let's start with our discussion number 325. Welcome everyone on our Saturday investing discussions. Talk about what's happening in the market. We do cover what's happening in the recent the week, but I would like to focus on the aspects which are like timeless, work, are not tied to a particular events of the week, but something that will stay with us for longer term, right? So one big topic that I wanted to cover today, and I thought it was appropriate because a lot of folks who have been assigned, who work in corporates, and then you get your ESPPs or RSUs, and you might have a good position in your company stocks, and those worked well. If you're in a tech company, yeah, those semiconductor stocks worked well, but then you're at a stage where you might be losing sleep, saying, "Come on, if we see a cracks like what we saw on Friday." And then you'll in a trouble. So how do you diversify without paying taxes, right? So
Maybe
I
put some over here and
I
then
think
go to
some.
that.
Oh no, sure. I need to put everyone on mute. So I think I briefly had covered. I maybe touched upon this topic maybe last year, but I thought maybe it would be good to revise this and see how, if you have a concentrated position and you have had enough gains, what are the strategies that you can use to diversify it. We'll also finish up the topic that we started last week on ETFs, in evaluation of the funds and the ETFs. The second part of the discussion was around some of the crazy ETFs that I've seen in the markets. And over the last 2 years, I just want to touch upon some of those ETFs and tell you what's the investment case, and what those ETFs are for, and it might work for some, and you can then decide whether those ETFs are for you or not. All right, we look at a high level macro side. What happened? We got some good economic reports, but that we are back into good news is a bad for market. So we look into those. What else? There are some earnings that we had. So if you are interested, maybe I'll quickly go through some of the companies' earnings. And yeah, I think we have enough on our plate for today. If you have any questions, yeah, put in the chat or raise your hand. I'll unmute you, and you can ask any questions that you may have. All right, with that, let's get going. As always, anything that we discuss here is only for education, entertainment. Please don't trade based on whatever you see in this meeting or in any other meeting. Right. Okay, so looking on a Friday we had a deep sea of red, especially on the tech side. Nvidia down like 6%, Broadcom down another 8% after Broadcom was down like 15% post earnings. Micron down 13%, AMD. These all were the winners of last few months, and a lot of gains. They gave up a lot of their gains. Not too much, but I think even if you look at these companies, probably they are still big winners from a year-to-date perspective, right? But Friday wasn't a great day for them. Whereas on the other side, it's not that the whole market was dead. On the other side, if you look on the consumer staples, we see a lot of greens on consumer staples. The Procter & Gamble up 4%, Coca-Cola up 3%, Walmart up close to 1%. Healthcare was great. So healthcare overall from a yearly perspective is still negative, but on a Friday it performed much better. Utilities all green, real estate okay. The more of the issues or the weakness in the market on Friday was all related to technology and communications like Meta and Google's and some of those high beta stocks, Tesla's of the world, right? Berkshire Hathaway was up close to 2% on Friday. So again, important message: if you want to deal in individual stocks, like Harkini was saying, some fund manager talks about, or some market commentators are saying it's a stock pickers market. Sure, but then you have to go through the volatility of those stock pickers, right? You have to be okay with Micron down 13% in a day. Not many people can go through this volatility. Right? I know a lot of investors who would say, give me 7%, but don't take me through this volatility. I don't want to lose sleep in the night. Yeah, then invest in maybe dividend paying good stocks. You're not gonna make a lot of money, but then it's okay, it works for you. Right. So extending a time horizon on a weekly side also, I think we still see the weak performance on the tech and the communication side. But overall, a lot of financials companies did good. Right? Industrials are doing good. Consumer staples, energy, real estate, healthcare, but they're all still doing fine on a weekly basis. So if your portfolio is a little bit diversified and not having everything focused and concentrated on one type of sector, that's fine. Right? Then the days like Fridays or weeks like these, will be easy to get through. But then you also won't enjoy the gains that you might have had on the tech sector, which is like NASDAQ is up, what, 30, it was 33% in 1 year. I think the start of a year before Friday, it was up like 20 or 22%. Let me look at QQQ right now. And we are looking at QQQ is up year to date, 15%. While we sit here and think about, oh my gosh, Friday was bad. Come on, guys, 15% in 5 months, right? That's a great returns to be had. So don't beat yourself up. Markets are still doing okay. I think SPY is also maybe 7 or 8% up year to date. We're looking at 8% up. So that's I would say pros and cons of investing, having a concentration either in a company or in a sector, is that you will be tied to what happened on that particular day on that sector, right? So and looking at monthly side for last 1 month, sure. I mean, we are still ended except IWM. All of the others, like the indices are all positive, even at a monthly level. So I know it sounds little maybe a callous saying, come on, you're just underestimating what happened on Friday. Sure, on that day wasn't good. It wasn't good for my portfolio. It wasn't good for many of your portfolio, but extended horizon, we're still doing fine. You cannot expect market to always go in one direction. This is just a part of our investment. This is a ticket price that we pay to enter into the arena where we have a chance of beating inflation and treasury income. So, and some of these days will come, right? Especially markets generally go up in escalator and then go down in elevator. And that's the reason why is, the down moves to us feel us too aggressive because, oh, come on, it's down in a day, it's down 2.5% or close to 3%. But it took 3 weeks. I'm talking about S&P 500. It took 3 weeks for S&P 500 to gain 3%. We were back to where we were on 19th March. We haven't lost much. If you go back and look into SPY, we're looking at SPY, right? Let's look at SPY chart. So on a daily side, we are back to where we were, let's say here or here. Sorry, not March, 19th May, right? So nothing much has, I mean, as of Friday or as of today, nothing much has happened. Because the change came in a day, it feels too drastic to us. That's human nature. But once you understand, this is how the market generally behaves. It goes up in escalator, it comes down in elevator. So be prepared to go through this volatility if you're investing in the stock market. Otherwise, treasuries are still yielding 4% plus. Be happy with the 4%. And if you can, set your life around that 4% and don't get FOMO because the neighbors are getting rich, sure, then you don't have to deal with this volatility. Ravi says, morning, good morning, Ravi. What's my view on HPE? I don't own HPE, but maybe we can do a quick analysis later on. Sam said lost 39K on Friday. Don't worry, I'm on your side with a bigger number. Okay, just on Friday, if I look at the drawdown in overall portfolio on Friday, I beat you on that, Sam. But that's okay. We have had much better gains over the last few years. Who cares? Go ahead, Sam. You have a hand up. What's the question?
Vivek, do you remember a couple of months ago I said my portfolio's going up and down like 15,000 a day? So, that 40,000 doesn't really bother me any longer. As you see, I bought some shares of a stock that might go up. I think Broadcom is a good business.
I would say it's not a bad business. I have earnings of Broadcom if you want to look into it. I think that the quarter was exceptional, right? The earnings quarter was exceptional, but the issue is that if your stock is up like 60% in a month, you have to do better than exceptional. Only thing that Broadcom did, and a little bit digression from our path, since we brought up Broadcom, I think there are two things that market didn't like on Broadcom. Number one is Hot 10 did not raise the guidance from their AI revenue by 2027 to more than $100 billion. So he kept the guidance to be $100 billion from AI related revenue, which he had told the market earlier also that it's going to be $100 billion. For whatever reason, analysts were expecting, oh my gosh, he's going to come and raise that guidance. He did not. Number two was their software revenue, which is their VMware revenue. We see the growth is not that much. I think it grew only 9%. I may be wrong in number. We can look into the Broadcom report. So that was a second concern, that your revenue is not, the other revenue is not growing that much. Third was they had a customer concentration, because I think one of the biggest customer is Google. So you have, hey, if you are like in bed with Google, or you're in cahoots with Google, they probably gonna drive the terms and conditions of the business in negotiation. So you always a little jittery if majority of revenue is coming from one big customer. So they have a customer concentration risk. I think finally the fourth one, which I found in the report, was even though their revenue has grown, their margins are coming down, because doing this work for building ASICs for Google and other hyperscalers, it's a little lower margin business. So while your revenues are growing, if you look at their gross margins, they've actually decreased. So market was a little bit concerned on that one. But again, these are long-term concerns. I think for this particular quarter, they did really well. But guys, your stock is up 60% in a month. Right? A lot of that growth is already being priced in. So Broadcom down, I don't know, wherever it is. I don't own the stock, but if you look at its where it is. It's back to where it was, what, 2 months ago? So I think that's why it's just that the stock has a great run up over last, I was since 526 in last 10 sessions. It had a huge run up. So just gave back that gains because hey, I don't think the business was bad, but there are some of these areas of concern that you should be aware of if you are Broadcom investor. So my portfolio is 1/3 tech. Friday's out. Yeah, but then again, you enjoyed a great gains on the tech side over the last 2-3 years. Right? So I think I probably borrowed or somewhere I read it, and I like to quote this often, right? When in doubt, zoom out. If I start doubting that the techs won't perform or techs are bad, just zoom out and look where it come from over last 1 year or 2 years. So if your portfolio is 1/3 tech, you're doing better than majority of the other investors. Which is down 11.26%. It was like a Hulk roller coaster, right? Yeah, 11.26% down means probably you probably have a lot more concentration of individual stocks that have gone down on, and again, don't know in terms of what okay, so you already mentioned what those stocks are, like Avgo, SanDisk. SanDisk has been a winner for this whole year. Like it was up some 600%. You show this chart to anyone, and no one call this as a chart of a losing investment in 2026. I think the problem is if somebody bought it here or here, sure. I still feel, I still don't have a courage to pull plug on becoming bullish on SanDisk as a business, even at this price point. It's more still a cyclical business. Margins are not that great. Sure, it's an AI tailwind that is pulling it up. Yeah, let others make money. Me personally, I'm still staying on the sidelines and watching the fun on SanDisk. All right, getting back to what happened. So this week, like a lot of the other sector that hitherto hasn't performed this year, healthcare, even though this week it was up 3.5%, it is still negative for the year. Right? Financials is another one which is still negative for the year. So these are called the so-called the safe sectors: healthcare, utility, real estate, consumer staples. They all performed green this week, while some of the other higher beta, tech, communications, Teslas of the world, they underperformed this week. Looking at 1 year, 5 year, 10 year, whereas a 30% tech, you've done great in last 10 years. You've been up like 800%. Right. Even for a 5 year, that sector has outperformed every other sector. Information tech is up 170%. Sure, on Friday, you felt the pinch is down almost 6%. But looking at a year to date, right? If you look at a year to date, we have what? 3 sectors are down year to date. Financials is down 4.5%. Healthcare is down close to 1.5%, and discretionary is down to 0.5%. Otherwise, we're still doing good on a year-to-date basis. Tech is still the dominant one. Even after the carnage or turmoil of Friday, tech is still up 16% year-to-date. Like we looked at QQQ is up like 15%. Like, what else do we expect? Are we becoming too greedy? I think that may be a reason we feel the Friday was bad. I think we're still doing good, even after whatever happened on Friday. Cool. All right, what else? So we had some key economic numbers that came out, and some of that has contributed to what happened on Friday. So that's why I want to go through some of those numbers. I'm not a big macro level investor, but I know some of you guys want to know what happened this week. For me, great businesses will find a way to survive in any kind of economic situation. Right? So, but there are some sectors that are affected by these macroeconomic factors. So if you are investing in those, maybe you should know about this. So we had a jobs report that came out, which talks about the jobs on numbers for the in month of May. So the consensus or $85,000, 85,000 non-farm payroll jobs to be added. We did almost more than double. And that was one reason why the markets were like, wow, the economy is hot. We had like 172,000 jobs that we added in May. So from a job perspective, economy is still doing great. Unemployment rate, on the other hand, stays steady. It's like steady at 4.3%. We did not see increase in unemployment rate. Right? And the PMI numbers, manufacturing PMI is at 52.6, services is at 54.5, little more than what the market was expecting, and decent amount of job openings. So if you just look at this, it'll tell you the economy did great in May. Right? We have more people being employed. There is no change in unemployment numbers. We have more job openings than previously. Our average hourly earnings haven't, it's year over year, it's grown 3%. So it looks to be great. But what does that mean from a market perspective? We are back into the phase that as seen during 2022, 2023. Good news is bad news for market. Right. So we're back into that like good news, bad news stuff. And if that means that the economy is still continuing to do good and the labor market is still continuing to hold up, why would Fed decrease the interest rates? That's one big concern that market had was we're not probably will like it is making the market is making job of Kevin Walsh more and more difficult to cut the interest rates. Right? And that's putting pressure on the markets, especially on the smaller segments of the market and the companies whose earnings are way out in future, or we have priced in a lot of future growth already into the stocks, and that's why we saw a lot of these companies, including I would say Russell 2000, performed worse than the rest of the markets. Because now if your discount rate, if you run your regular discounted cash flow models, where discount rate is continuing to stay higher than the present value of the future cash, becoming less and less attractive. So, but from economy perspective, I think we're still doing great. So we have a resilient economy. We added so many jobs, but the pricing pressure still stays up because I know inflation is not giving up. Inflation still continues to stay consistent. So great job market. And then we are seeing the wage growth is not still okay. It's not decelerating. We are still getting like 3.5% average hourly growth in earnings. So from economy perspective, still fine, but not enough that the wage growth is decelerating, but not enough that we can forget about inflation worries. So Fed has only two mandates. The Fed mandate is not to make sure that the markets are up. Fed mandates are inflation, control of inflation, and job market, right? Maximum employment and stable prices. In this case, we are at great when it comes to the employment. So Fed doesn't need to do anything to prop up the labor market. So they don't need to cut rates to make it cheaper for companies to raise funds so they can hire more people. We are already like in the markets, we are from unemployment perspective, we are already good. And we are already seeing a lot of job openings, and we are seeing non-farm payrolls also were double than what we were expecting. So Fed has no reason to cut rates to prop up the labor market. Let's talk about inflation side. Is the inflation below the target? No, yes, inflation is still being stubborn. So what's the reason? How will Kevin Walsh be able to justify any rate cuts? So that's the reason why markets like now pricing in. Forget rate cuts. Now we are talking about possibility of rate hikes back on the table. And we saw, I think, European ECB or some Europe bank, central bank, they actually raised the hikes. Japanese central bank is now raised, they're raised to 1%, which is from a Japan perspective, it's huge. So when you have the central banks across the world raising rates just to, cool down and get a control on inflation, it will become harder and harder for Kevin Walsh to justify why he wants to increase the rates, and also to bring, other Fed governors onto his side. So from right now, I think now we have started to market has started to price in at least 125 basis rate hike by end of a year. And when you're looking at a rate hikes, that's never good for those businesses whose earnings are far out in future, or the businesses who depend on a loans, for or raise or basically borrowed money, because then the cost of borrowing becomes higher for those businesses. And those are the, like, lot of our companies in the Russell 2000 index are those companies. That's why if you look at maybe IWM, which represent Russell 2000, how did it do on Friday? Yeah, so IWM also had a bad day on Friday. These are the companies that they survive on loans. Now loans becoming more expensive is not good for their business. Other companies are where the earnings are far out in future. So when you run a discounted cash flow, the present value doesn't look attractive. Those are a lot of the tech companies. Right? So that's the reason why we see a lot of weakness in these two sides. So market is pricing in a higher path for interest rates, and that's what we saw what happened on Friday. Now we're looking at a weekly return. Like on this week, the Mag 7 return, right, is a weekly return. We got what, second negative weekly return for Mag 7. What else we saw? Fear and greed index is now in fear, not in extreme fear react. I would love for it to be an extreme fear so we can start deploying more and more capital. But yeah, this is a much better time to deploy the capital as compared to where the market was when it was in a greed, right? Around 62 or 64. Last few weeks, it has been stubbornly and in this green zone. But I like that it is now in red zone. At least it's a better time than in last, I would say, 6 weeks to deploy some capital. So again, this is a weekly setup. My take is, given the fact that we are having a stronger economy, it means there are more sectors of the economy or the companies will do good, which rather than us being driven only by the technology sectors, like other sectors will also perform better. So if you own a diversified portfolio of, if your portfolio is holding diversified companies, like, I think that should still be fine. A lot of other sectors will benefit when consumers start to spend money. So the broadening of a market leadership. So you get broadening only if the prior leaders come down and the others that have not performed start to go up, and the capital has to rotate. The other reason which I am hearing commentators giving is that, hey, we are having the biggest IPO of the in the history of the US markets next week. 12th is when the SpaceX goes for IPO. And whether you like it or not, I think there are many companies that are trying to prop it up, and many companies would want it in their portfolio. Maybe because they want to, be pally with Elon Musk. So if you need to find capital to deploy on SpaceX IPO, where are you going to find the capital? You will sell whatever has worked for this year and pocket the gains. As a fund manager, that works better for me. I can say, hey, in Q2, we are up realized gains. So, hey, we are up like X% because I already realized those gains. So a lot of companies that have already performed this year, Microns on the world, Broadcoms of the world, NVIDIA hasn't performed that great. But a lot of these companies, SanDisk of the world's, wherein those stocks have been up gazillion% already this so far. Yeah, sure. If you sell those stocks, you're not going to lose your job.
I think that is maybe the reason we have kind of going to see a bigger air pocket here, where turbulence, because the purported market cap for SpaceX will be 1.7 trillion, right? So 1.7 trillion dollars worth of cash needs to be kind of raised from the capital markets, and you're right, like these profitable positions in Marvel and all are being dumped.
So little correction, 1.7 trillion will be the market cap, but I think they're raising only $75 billion because the float is very less. So, but still, it's a big amount that if you need to deploy the capital, you need to spend, and where the money is going to come from. Like as a fund manager, if I sell my position, which is already up 100% or like 60% in 6 months, my company is not going to fire me.
And also the rich people are being kind of encouraged by Mr. Diamond sitting in the meeting with this guy. So I think the rich people are
they all are pandering to Musk. It was a little disgusting to see Diamond interviewing Musk around the whole SpaceX stuff. But it is what it is. But good thing to see that at least the Standard & Poor's, they did not succumb to the pressures of SpaceX, and they say, hey, we're not going to include SpaceX in S&P 500 the moment it comes out to IPO. So for those who don't know the background, NASDAQ had changed its rules of inclusion in NASDAQ index to include SpaceX, ASAP once it starts trading. They used to have a certain number of rules that the stock should be trading at X number of period before it becomes eligible for inclusion in the index. The float should be X%, so and so forth. Now for SpaceX, they've thrown out all those rules out of the window and created a new rules just to favor SpaceX so that the SpaceX get into your NASDAQ index. What does that mean? Whether you like it or not, whether you like the valuation of SpaceX or not, it will get into your portfolio, right? Because you probably have your retirement funds in QQQs or targeted retirement funds, which is very popular in instrument. They are invested in these broad market indexes, right? So you'll get some portion of SpaceX anyway, whether you like it or not. Good, at least S&P 500, the Standard & Poor told they're not going to include it. They'll still honor their rules that they have set up. Anyway, so yeah, it's going to be an exciting day on June 12th. We'll see how the market behaves. I have no interest in owning SpaceX at the valuation which it's coming at IPO at. More power to you guys. What do you want to do? I feel that we may be able to buy it at a better pricing sometimes later in a business, and I really want to give it a couple of quarters to see how the business performs. Right now, all the valuation is just based on the story and the fact that it is Elon Musk, which is great. Maybe if you want to put in, or if I feel like putting in, I'll put maybe some of my Vegas money onto it. Right, I'm not going to put my retirement money or pay my mortgage money on SpaceX. Right? Look at the guts of Elon Musk around. I mean, they don't have a range of pricing, which is a very unusual when you're doing a road show. So generally, the companies will come up with a range at which they would want to price their IPO. Then they go on to roadshow, try to sell this and talk to institutional investor, Wall Street funds, pension funds, try to gauge an interest and see what the other investors are thinking, what the company may be worth with, figure out where what price point they'll be willing to buy and hold these stocks. None of that stuff works with Elon Musk, right? Elon Musk, like
if you're I mean, this is a nice strategy for a con man, right? You can create artificial scarcity and say, this is, it's a con man game in my mind.
Yeah, so it's like $135, take it or leave it. And I'm sure a lot of the Wall Street managers will bend their backs and fall on the feet of Elon Musk and try to sell this $135 per share to the rest of the market. Remember, he's also allocating 30% of the overall IPO shares for retail investors. Right? I'm not surprised. The retail investors have always bagged Elon. They don't care about what the valuation is. They care about the meme component of a lot of Elon stocks. So they'll lap it up, and that's why Elon is allocating 30% to the retail investors. So there will be a lot of bag holders in this one, but never ever discount Elon Musk. He has done wonders earlier also. He could pull this off. But if you want to be on that trade, up to you. I would want to see the business performing better to justify the valuation. And I don't want to bet all my thesis on Elon Musk. Right now, all your thesis is on that it is run by Elon Musk. Right?
And so that's also the risk, right, of a CEO who's on drugs and he's the only guy.
Yeah, I mean, it's a key man risk in all the company and who's also distracted by a lot of other companies.
And on drugs also, right?
And there is no absolute, no corporate governance, etc. But there is a section of investors who love these stories, right? Who want to talk about, let's say, I think it was Vinay who was talking. You can never go on to in a cocktail party and say, dude, I own VOO. Like, come on. You go and say that you own SpaceX, people will turn towards you and you'll generate it. So these are the stocks that become talk of the party, right? If you want to own this, right? And some people want to own this. All power to them. Not for me. Though not for me. Right? But he's a great guy. That's why I'm not going to short SpaceX. Or I'm not going to short.
No, that's okay. You're fine.
Right? But I can't buy it at this price point. At trading at 100 times the sales, not for me. Sales will probably rise to justify it at some point of a time. I mean, if you squint too hard, at some point of a time, you might think, yeah, it's maybe could be valued at $1 trillion, $1.5 trillion, from their own perspective. The total TAM is $28 trillion, out of which $26.5 trillion TAM is coming from enterprise customers of AI, which is XAI. We don't even have a single XAI enterprise customer except SpaceX, which is like their own the ownership companies. Like XAI is a subsidiary. It's been subsumed. Who other enterprise customer you know of has adopted XAI? Could XAI be the best LLM model and could swamp the whole enterprise software, the market? Time will tell. But do you think at that point of time, Microsoft, Google, Anthropic, OpenAI, they will like sit quiet and let XAI garner all the market share? I don't think so. So
XAI has become I don't know if you noticed the recent announcements. they have become more like an infrastructure provider. Both their data centers are full. They're making $2 billion, like close to $2 billion per month.
So that's so that's from the SpaceX Colossus data center provider perspective. Is it that they're becoming competitor to AWS, Google Cloud?
He's just good at Elon is just good at building this physical infrastructure, and that is what is paying off. Like he's now rolling into $26 billion of revenue from XAI into SpaceX revenue.
No, it's not $26 billion of revenue on XAI. I think Anthropic has signed a deal with them. I saw Google has signed a deal with them today.
Yeah.
For almost $950 million a year deal with Elon, right?
That's per month, right?
You can check it out. Again, my question is that there are players who are not gonna sit and let XAI take away all the market share. Today, everyone is starved of compute, and that is why they're getting all the deals. But the money, the eventual money we still don't know whether this all compute will eventually result, what's the ROI of that on that compute is. And we still have to see for how long can these companies continue to invest and consume this compute capacity before they say, guys, we're not seeing money being paid by end consumers for it. So my whole idea is that don't depend on Wall Street machinery to tell you that it's a great stock to buy. Right. So the same JP Morgan also told us that the WeWork is fairly valued at $47 billion. I think JP Morgan was the lead investor, the lead banker in WeWork case, right? So I don't have any faith. They have a. I shouldn't blame them. They are doing what's best in their interest. You have to do what's best in your interest. So Goldman Sachs will tell you, I will not be surprised if I suddenly start to see a lot of positive news coming from Goldman Sachs, because Goldman Sachs is the lead banker on this one, and then there have a consortium of other bankers. I will not be surprised to see positive news coming around Elon Musk and his companies from these set of bankers. That doesn't mean suddenly the other businesses have become much more better in quality. It's just that, come on, they need to pander to Elon Musk. They have to worry
about. But they download it too. The bankers, they won't keep it, right? They have to download it somewhere.
Yeah, but I mean, they also have some guarantees of underwriting at a certain price, etc. So they want to make sure that the IPO goes out at that price, and of course they'll sell it to their institutional investors and all that stuff. So everyone in this market work for their own personal interest. You got to figure out, you have to work for your own personal interest. So I don't pay any, and I pay attention, but I don't act just because now Goldman Sachs is saying that they can actually see some path to $1 trillion revenue. Right? Maybe it's right. Like I said, if you squint too hard, maybe you can find it a way, but make sure you understand it, what they're saying. And if you're okay with this, sure, go ahead and invest. I'm no one to tell that don't invest. Just that you have to figure out if that's for you or not. I can't see myself investing sitting today, and it's okay. If it becomes from $1 trillion to $3 trillion, well, that's fine. If it's a great company, probably it'll become a first $10 trillion company, and I'll buy it at $3 trillion. If the business becomes better at $3 trillion.
So here's the funny part though, like I was crunching the numbers and seeing, so that in 2025, Apple's revenue was around $450 billion and their market cap was around $2 trillion. It's almost like, let's say, 5 times, right? Google had a similar thing. The profit margin around 40 to 50%. The MasterCard profit margin is 60+%. And they were trading at the 10 times of their revenue.
Mm-hmm.
Now this company has a revenue, or even Walmart has a $680 billion revenue, and they were trading at the 2x. I mean, their market cap was 2x. Now, this company who has barely $5 billion or whatever, $10 billion revenue, and they are asking for $1.7 trillion valuation. That's insane. That's absurd, crazy.
Yeah. But come on, it's Elon Musk. No one else has Elon Musk, and I think market wants to give that credit to Elon Musk. So okay, you have to figure out what works for you. I mean, I don't want to pay 100 times the sales, and I think 2026 revenue is projected to be around what, $26 billion or something like that. Right? Maybe become generous, give them $30 billion. Right? And maybe say, hey, they continue to increase their revenue by 20-30%, 30% per year. There is a lot of Elon premium baked into it, and that is why he will be able to sell it at 1.75 trillion. I will not be surprised if it jumps up on day one. I will not be surprised. Right? I don't know how much it will jump up. It's already $1.75 trillion, but there are a lot of people who markets have changed in terms of, from a short-term perspective, market has changed a lot after 2020, where there are a lot of people say, okay, I'll buy in, it'll get an IPO, it'll get a 10% jump, I'll sell it. So that itself will create, or you go and buy out of a money call, that will force the market makers to hedge it by buying the shares, and that could, push up the prices higher. We have seen these kind of a gamma squeezes earlier also. Right? Even though the businesses may be really, really broken businesses, but then there will be investors who will say, oh, I can take a bet. Maybe I'll go and buy 20% out of the money call on it. And then many of those investors individually, they think they're buying small portion out of a money call, but then you have a limited number of market makers. Right? They all will be trying to, for them to become delta neutral because they sold the calls to you, they're going to have to buy the shares. And that might create those gamma squeeze that we have seen earlier. All right. Great discussions. I think next week we'll figure out what happens in the market. Will that be a top? Who knows? We have 2 more companies coming up in public, right? We have never seen a spade of like multiple trillion-dollar companies coming on IPO. Right? This is such an exciting time. That makes me a little more bullish on some of these investment banks and the financial sectors. Is I don't think we have priced at the start of a year. We didn't price so much of a listing gains for these investment banks. Right? The Wall Street is going to make a lot of money by bringing these companies to public. Whether the investors who invest it are going to make it or not, that's a different stuff. But the bankers going to make their fee. And I think Elon Musk anyway told them that, hey, you're not going to get your regular fee. He needs to have a discount, and he'll get his discount. But even with a discount, they're raising $75 billion. Even if you like have a 1%, that's still big amount of money. So a lot of IPOs this year. If Anthropic also coming with an IPO, I think Anthropic has already filed S1 confidentially. So once it become public, maybe I'll bring it up for a review like I did for SpaceX. We'll review and get to see some insights into Anthropic. Great business, grew like 80 times, not 80%, not 8%, like 8 times, but 80 times growth in revenue. Great. The bigger question is, all right, how much are you spending to get that revenue? And is there an eventual path that you as an investor feel that could be, there is a path for them to become a profitable business or not? We'll see. Let's not jump the gun. For now, we'll wait what the SpaceX IPO does to the market on next week. Right. All right. Since we talked about these companies and the Wall Street stuff, let's finish our backlog from previous week, which was around a lot of ETFs coming from Wall Street firms. Right. So last week we talked about, if you're analyzing an ETF or a mutual fund, what are the things that you should look at, right? We talked about the track record performance. We talked about the expense ratios. We talked about who's running it, who's managing it, and so on and so forth. So if you were not here last week, go on watch the recording. This is in continuation. We ran out of a time, which I'm sure today also we will. But I also wanted to cover in terms of some of the ETFs that I'm seeing have come in the market, like crazy ETFs. And before you invest in those, try to learn about those and see if that's the right instrument for you or not. So I'll bring in some ETFs for discussion. You might have a lot more on the list. So let's make it interactive. I only pulled in a few examples and you can add a few more. So first of all, ETFs have been on fire, at least in the US market. This is in Indian market, ETFs are not that big. They're still mostly run on mutual funds. But in the US markets, ETFs have been garnering a lot of assets under management. Folks are moving money out of mutual funds and putting into ETFs because of tax efficiency and all that stuff. Lower fee and better in terms of controlling your own taxes. So while we had all this turmoil in the market, one big detail that was not talked about was VOO. It crossed $1 trillion mark of AUM. It became the first fund in the US market to have $1 trillion asset under management. Right? That's VOO. And more than 50% of the new money is actually getting into ETFs. Add that to a lot of passive ETFs. While the active fund managers are being stopped or the money has been moving out from them. And the overall ETF industry has been, every year they shatter the records of new launches, new money coming in, AUM, and so on and so forth. Because a lot of investors, including a lot of retail investors, have become a lot interested in investing in an ETF. Right? Because the way the ETF started, the way this industry started was, rather than you trying to take a bet on individual stock, why don't you invest in a broad basket of stock? And through the ETF route, we can give you a cheaper way to invest in and also more tax efficient way to invest in. Right? It was a great call. It was a great thing to do for retail investors to democratize us to get an exposure to big 500 companies on that trade on US market rather than me trying to pick individual ones. But over some period of time, especially in the last 5-6 years, the colors of ETFs have changed. Different crowd has started to play in the market, and now there are ETF issuers who are there to pander to that crowd of, I want to, I want to make quick gains on these ETFs. Or give me a leverage ETFs, give me 2x leverage, give me 5x leverage. In the Wall Street parlance, it's called a hot sauce. Right? Give me the newest, hottest stuff on which I can trade on, and it's being wrapped under an ETF structure. So nowadays, if you hear someone say, hey, it's an ETF, don't worry, it's an ETF, that definition of ETF has been polluted. Now some of those ETFs are as risky, or I would say even riskier than some of the individual stocks that you may see in the markets. So let's look at some of them. First, I will look at the category types. Then we'll look at the issuers and also some of the individual, these funny ETFs, I will call it as. So there's an ETF called Defiance Poet ETF. This is a 2x leverage fund on a single stock company called Poet Technologies. What does Poet means? Photonics, optoelectronics, and emerging technologies. This is a company called Poet Technologies. And I think it was like 3 or 4 years ago, SEC had allowed issuers to issue ETF on a single stock. I mean, tell me, how does it make sense? You just buy the stock. ETF was supposed to have a basket of stocks underneath it so that diversify your risk and you don't have individual stock risk. Now you have an ETF on an individual stock. Not only an ETF on an individual stock, you have a leveraged ETF on an individual stock. Right? So Poet is one. The whole concept was, hey, and we talked about this, right? So then in the whole AI race, there were chips, There were energy companies, the data center, there's a memory company. Now we're talking about the transfer of data. Look, instead of using copper wire, we are using photonics, optoelectronics, and the this is a company that is like a lot of investors, especially I guess the retail investors, are falling over each other to invest in this POEL. It was only 15 days old and it was already up like 200% AUM. Everyone like, oh, come on, I want to have a piece of this. So these are the things where I'm get a little scared of, like a lot of a FOMO getting into this, right? Hey, I missed the bus on NVIDIA. Let me find out which is the next NVIDIA and double down on it. Okay, is there an investment case to be made in this sector? Sure. But is this the right instrument to invest in? I'm not sure about that. So POEL is one. Corgi is basically capitalizing on the EUV, extreme ultraviolet lithography, right? I own ASML. I've owned ASML for now 6 years. I love the company. I love the mode the company has. Okay? But now we got a Corgi. I don't know what else is under Corgi. So they got a ASML. They got a Zeiss, which is, you know, the other, the partners, etc. of ASML. So these all are cashing in on the current bullish narrative around the semiconductors and the chip making. So Corgi basically into the chip making, they focus on the EUV side. What else? Roundhill, real world asset strategy, right? Halo, Aloha, basically heavy asset, low obsolescence, I guess, whatever the word is. The whole idea was that these AI models is gonna make software, you know, if you're having a vertical software or a SaaS, you know, AI models can create a software much quicker, which is true. You know, you don't have to wait for an army of software engineers to build some of these softwares. You can use some of these AI models and become a lot more productive, right? And then it means any of the modes that we thought that the software has, the software building mode has completely vanished. But what AI cannot do is cannot create a physical goods. So heavy asset. So it means heavy assets suddenly became a lot more popular. So why not an ETF based on that? So they have, instead of buying, you know, volatile cryptocurrencies or the software, we're going to buy the physical assets, which AI cannot replace: real estate, you know, private artwork, etc. We are seeing some lot of companies coming up with the leverage ETFs on the day one. And this was the first time in the history of ETF industry happened that when Cerberus came up with their IPO, within 24 hours, we had 2x leveraged ETFs that started to trade. Has never happened. Now, these issuers, I don't know who, maybe it was Roundhill or Tootle, one of them probably did this. So these issuers have become smarter. They've figured out that, come on, there's a lot of hype around these IPOs, and there are investors who like, oh, I did not get any allocation on the IPO. Now I'm I have a revenge trade. I'm gonna double down on it. I'm gonna go and look for something who can give me 2x leveraged, right? Because if the stock goes higher, 10%, I'm gonna make 20%. So these issuers become much smarter rather than wait, which used to be the, you know, the norm. They are filing up. They are already filing up the applications with the SEC and keep everything ready. That the moment the stocks start to trade in the IPO market, your 2x leverage is already available. Cerberus was the first one to do. Now SpaceX will not be behind. There are already filing with SEC for 2x leveraged SpaceX, basically in ETF, which is twice leveraged on SpaceX. And there are filings already filed for OpenAI and I guess Anthropic and all that stuff. So the day these companies get launched, You might see on the same day these 2x leverage ETFs will be available. Why is everyone rushing here? What's the rush? I don't think anyone actually care anything or give a hoot about retail investors. They will come and talk about it on the financial channels that we want to enable retail investors to express their opinion. They can make money, blah, 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 blah. But if you've been in the market for long, you know nobody care about retail investors. They all care about making money. And there is so much of a rush because each of these issuers, they're guaranteed to make huge amount of fortune in the fee. So Tesla ETF is the oldest one with the biggest AUM, 2x leverage ETF. It's got a $5 billion asset under management. Its expense ratio is almost 95 basis points. That means pure $45 million, or right, more than $45 million, $47.5 million, close to $50 million of pure profit for issuer without any additional stuff, doing any additional work. They had to do the initial work when they launched this, in terms of setting up ETF, bringing new ETF to the market, doing the reporting and all that stuff, make sure infra is ready. Now 5 billion sitting under it, it's a pure highest gross margin business you can find on the world. So why not? Why not do it? It's a hugely profitable business for these issuers, and there are investors or traders, or call them degen folks, those who want exposure like this. So I won't be surprised to see many and many of these things coming out in the market and being bombarded with it. There'll be more folks who will come onto the podcast, who will come onto the CNBCs, Bloombergs, and talk about these instruments because it's a money generator instruments for those issuers. The bigger question is it money generator for you as an investor? Right? Nobody knows. There's no guarantee. Only guaranteed thing in this is that the issuer is only guaranteed thing is the fee, which goes to the issuer pocket, not to your pocket, unfortunately, right? So yeah, let's do it. And now over the past few years since I've been watching this, I've realized that there are some issuers who love to deal in these hot sauce products, right? Vanguard is not one of them. Vanguard doesn't do it. State Street is not one of them, even though there are a few instruments, but there are smaller issuers who become very prominent in the last 5-6 years, ever since the retail crowd become a lot more active in the market, right? Defiance is one of them. Defiance has been around for longer. Yield Max, right? After the interest rates went higher, you can get higher as a call premium. You see a lot of Yield Max like covered call strategy ETFs, CONI, MSTY, GMEY, right? All these, no institutions buy this stuff. It's the people like us who get sucked into 20% dividend yield. Come on, half of it's your return of capital. It's not a dividend yield, right? Nobody bothers to check how much is the return of capital, how much is actually a dividend. Especially nobody retail investors check those things. We just get enamored by the headline number saying MSTY returning 20%. They're just giving the capital back to you. What you gave them? Direction. Direction has got a lot of leveraged ETFs. ProShares, TQQQ, UVXY, SBIT, UXI, Granite shares. And the Granite is like famous for leverage ETFs on an individual stocks, right? NVDL, which is for NVIDIA, 2x leverage, Facebook leverage. This is Coinbase leverage. Sorry, CONX, I don't know. Wow. AMDL is AMD leveraged. Roundhill is a DRAM. DRAM was like all over the place, right? You have seen market commentators talking great about DRAM stuff. And then Total Capital Management. They became famous by having a short ETF on ARK, right? And then they have the GMU, DJTU, and there are many of the stuff. So if you see folks talking about, your friends talking about some of these ETFs, these are general hot sauce ETF issuers, right? They tend to make a lot of money. So be careful, take a step back and see, is it for you or not? Maybe we can look at some of the performances. Again, everything's come with a lot of volatility as well. So DRAM, round hill memory ETF, it started here in April, ran all, it's like what, $20 or something, 20, $30, 100% in, what's it, like April 1st, 100% in 2 months. Huge volatility, right? It's now back to 55. Still great. I think still there's a lot of froth in this one. Again, DRAM is not a leverage, but it's based on what kind of a companies it owns, and those companies are a lot more volatile. But look at some of these leverages, MSTU, let's say, or MSTX, MicroStrategy. Leverage ETF. So I think some point of a time, you might, I think I do have, let's bring up that in terms of, if you think that owning a leverage ETF will give you 2x the return, if you're owning 2x leverage, and you want that 2x return, you will be surprised how many times that actually does not happen. Even if your underlying has gone up 10%, there's a chance that you actually end up losing money, not making 20%. You probably end up negative over a long period of time. But if you're trying to time it for the day, sure, could work out. For a week, sure, with little more risk. For a month, possibility is lesser, risk is higher. For a year, now you're competing against the math. You're competing against getting right on one path that the stock took to become 10% out of gazillion paths that it would have taken. We can run some numbers and see, if it works out or not. And I've seen a lot of a retail investor interest in that. So I pull in this. So TSLL, right? So looking at a Tesla starting from the 1st of January till Friday end. You guys can see a Google sheet. Let me make sure what you guys are seeing. What?
Yes, we see.
Okay, right. So I just pulled in and say, okay, let's look at Tesla. Starting on start of 2025 till date, Tesla has returned close to 10%. Right? Somebody can correct me. I think the number should be okay. TSLA. Let's look at Tesla. Starting at 2024, 2025. We were nope. Not oops. Oh, come on. Oh, let me see the number. What's on 2025? Tesla is 379.28. And today's Tesla is what? 391. Oh, so probably it was like prior to, it's 6/4, 6/4/2026. So maybe it's 6/3. In any case, look at TSLL. Let's plot TSLL over here. Or maybe we can compare it on Google Finance, right? TSLA versus compared to TSLL. The funny part in these stuff is it depends on the path that the stock takes. So now I'm looking at Tesla is up 32%. I've picked a 1 year. Your 2x leveraged is up only 20%. Like, how come? Isn't supposed to give like 60% return? Not necessarily. On the negative side, okay, it worked. It actually, Tesla was down 13%. It was down like 33%, not just 26%. 6 months is down 11%. You actually lost 3x instead of 2x. 5 year, wow. Tesla, okay, so they only started it here. So I can't say much about it. But even if you pick up from this price point, right? Tesla is still up from August 12, 2022, when this 2x leverage ETF came into being. Like, Tesla is still up. What happened to the leverage ETF? It's like down 50%. So these leverage instruments, a lot of retail investors get attracted to it. But remember that you cannot inventory it. You cannot buy and hold it. If you're buying and holding it for more than a week, now you're leaving it up to the God and praying that the stock should take X path to go higher, because only in that case your leverage instrument will actually give you 2x leverage. Out of many other paths where the stock could actually be 10% higher, but your leverage ETF, 2x leverage ETF could underperform, or worse, it actually could lose money, as we are seeing in case of Tesla. I cannot emphasize enough. Don't believe me? Go and listen to the podcast that the ETF issuers come and talk about it. Legally, they have to tell you what these instruments are meant for, and they have told time and time again, saying these instruments are not to be bought and held. These instruments are to be to manage your overnight risk exposure. Buy it for 6 hours, buy it for 12 hours, buy it for 24 hours. Don't buy and hold it. Okay. Listen to one direction guy, he came on a podcast. He says, we don't know why, like the retail investors are behind it, but this instrument is not meant for this purpose. So wrapping up our ETF discussion, leverage inverse ETF, there's a high volatility drag comes in. So you want to do the macro timing. I think someone was mentioning, like, can you do a TSLL for 24 hours? Yes, if you're kind of that kind of an investor or trader, sure. Right? I don't do 24 hours trades, for not for me, but there is an instrument available to express that opinion for 24 hours. Right? Just don't use the same instrument to express your opinion for 24 months. It's not meant for that. Single stock 2x funds, hyper concentration risk. Premium income synthetics, like we are seeing CONY, all these yield max, you have a net asset value erosion and you have a capped upside. Understand what you're getting into. And thematic products like DRAM, etc. Generally, historically, these will tell you this is the top of the market. When you see a lot of thematic ETFs start to come up, then it tells you, okay, there's a lot of hype in the market. These are the tactical tools. These are not the fundamentals for your investment for the long term, right? Especially the leverage ones. The structural engineering that make it great for a 6 hours, it becomes mathematically toxic for retail investment portfolio for 6 months, right? So don't do it. These things are meant for a particular reason. Use it for that reason. You cannot repurpose this a tactical tool to become a vehicle for generating long-term wealth. These are completely different stuff. These exist for a reason. If you have that reason to buy and hold, sure. But don't say I want to build a long-term wealth by owning inverse or leveraged ETFs. Right? So that's finish our discussion on ETF, guys. Hopefully will be useful to you. I'm seeing a lot of I shouldn't say crap, because there are people who want to buy it, give it to them, right? Like smoking, I won't say that you should not. Cigarette manufacturers are bad or they are committing crime. No, there are people who want to smoke, go ahead for it. Not for me. Doesn't mean I hate smokers. If it works for you, great. Don't say that you want to be healthy and then go and smoke. That's a concern I have. Don't say that you want to build wealth in the long term and you're buying and holding the leverage ETFs in your portfolio. If you want to bet for a weekend, sure. Right? All right, so that covers our ETF stuff. What else? Any question? There are a lot of chat. Hopefully you got your answers, but if not, just let me know if there are any other questions that I still need to answer. All right, let's move on to the other topic for today, which was around, or maybe I want to cover the crypto because I haven't touched crypto for last 2-3 weeks. Then we'll move on to diversifying from a concentrated positions. Okay, I'll sip some water. Meantime, anything else you want to talk to? You can unmute yourself or have a question. Ask me. I think there are. I lost the track of a chat, so you can ask me straight away. Let me get some water first.
Hey Vivek, this is Sachin here. I'm driving, so won't be able to type. There was some hype around hyperliquid ETFs. I haven't fully got the hang of what hyperliquid is or it does, but looks like it is being seen as a bridge to merge the classical finance assets, digital crypto assets, and looks like Bitcoin got crushed because of all these hyperliquid ETFs. Anything we have already talked about?
No. So Hyperliquid is again, it's basically a cryptocurrency. It's a digital exchange, and they have a token called Hype. And the reason, let's talk about. I don't think the Bitcoin got crushed because of that. There's other different reasons on some of why the Bitcoin, Ethereum got crushed, and let's talk about it. Then I'll address the Hyperliquid stuff. So we saw significant drawdown on the crypto side. If you look at it, like Bitcoin is now close to 60K. I mean, these things are very volatile and they still trade 24/7, so things could be anywhere. Yeah, now it's 60K and Ethereum is lower than like close to 1550, right? So lot of market in last 1 week, Bitcoin is down like 18%, right? This is more than 50% drawdown from October 2024 high, where it was like close to 125K. Now we are close to 60K, right? So there's a lot of weakness that we have seen over the last, I would say, 2 weeks in the market. Few things. Number one is these are still risky assets, and like a lot of consumer discretionary asset companies on the stock market got crushed, or the high tech companies got crushed over the last week. We are also seeing outflow from some of these so-called risky assets, like the crypto one is the same stuff, because the interest rates will probably hike in interest rate, and then it means you would rather not keep your money in more risky investments if you can get a better deal even on the safer one. So money has moved out of that. There is record outflow happening from these ETFs that we have had. So $1.67 billion has flown out of these many of the ETFs that trade on the markets, right? So we got a lot of Bitcoin ETFs, we got a lot of Ethereum ETFs. So we had the drawdowns from them as well. And the same reason applies here. We don't know why the drawdown happened. It could be, hey, I want to invest in SpaceX, or maybe a lot of some investors have told that, hey, it lost its plot. We don't think that the Bitcoin could become from a long-term perspective. We don't see any value in Bitcoin anymore, and hence they have just sold their holdings. Sure. Right. Third was we saw Zcash. There was some security flaw disclosure happened, and Zcash was like down 40%. Again, that's not a big portion of the market. I think the other big stuff which caused a lot more volatility was where is Michael Saylor? Right, yeah, Strategy, MicroStrategy, now renamed as a Strategy. For the first time, they sold Bitcoin. And if you have heard Michael Saylor, he would rather tell, okay, you better sell your kidney rather than selling a Bitcoin.
He's
Right, so
got a margin call.
so that's a whole stuff that they have had been is, hey, never sell your Bitcoin, sell your kidney, and they ended up selling 32 Bitcoin. I mean, it doesn't really matter because they still own 800,000 plus Bitcoin, but it's a more of a symbolic stuff that spooked the market, saying, hey, you told them never sell your Bitcoin, and this is the best asset. You put all your company's worth on that, and if you are selling, then it means what are we missing here? So there was a huge sell-off after we realized that Strategy has sold its Bitcoin because they had to cover the dividend payments. And if you look at Strategy has come up with all that financial engineering around STRC, STRK to provide dividends preferred shares, etc., to investors. And now all those are heavily SEC regulated instruments. So if you don't do it, SEC will come behind you. And so, they had to sell something. Again, I've not spent a lot of time this week to understand why they had to do it. I am at least happy that the this whole asset class will not be driven by one person. Like this was a huge risk if you're always dependent on someone savior like Michael Saylor to save this industry. That's never worked out well from a long-term perspective for any industry, right? So if that means Michael Saylor or Strategy will sell some Bitcoin, and if it survive, yeah, then that will tell us that the industry has matured. Otherwise, still a very nascent industry. From my perspective, it's still a very nascent one. Right? It's a 20-year time horizon. We are like 5, 6 years or 10 years into it. We still have at least 10 years to go on this one.
It
So
seems to be that this margin call will continue. They'll have another one. So essentially, it's a good short micro strategy, or Bitcoin will go down further.
I'm not gonna short these stuff. These things are very volatile. You want to go ahead, but right now I think STRC is trading at $97 or something. So he need to prop it up back to 100, and maybe like he'll sell more. Who knows? But what we also don't know is what the secondary impact could be. Maybe there'll be a buyer who'll get interested at below 60K. I don't know. I think there is the technicals, those who believe in TA, suggest that this is a 200-day moving average. And Charlie Munger's like 200-day moving average has been the best place to buy any stock, right? So we don't know if MicroStrategy does some bigger buyer step in. Who knows? So that's why I'm not going to short this. These assets are a lot more volatile than even Teslas of the world, right? The Tesla is not less volatile, but these assets have a lot more volatility. So I'm not going to short it, right? But you can decide what you want to do. I'm not going to short this one. I'll watch it. I'll watch it. There are some positive stuff that also is happening, right? Which is we saw some more. Yep, we're still waiting for a Clarity Act to pass, and back and forth we're going between in our Congress to get the stuff done. But this week again, there was a Ways and Means Committee will be holding a hearing on July 9th to discuss all the 7 draft bills around this one. So we get more clarity on it. We'll know where the market will move, how the institutions can play on this one. Then I'll expect a lot more traditional financial institutions to come and start playing in this particular, basically in the crypto market, right? There are still a discussion around the strategic Bitcoin reserve. Could US government, if that passes, could US government become a buyer at this cheaper price? Possible, right? There are sovereigns who bought Bitcoin. Could they, add up to their holdings? We have no idea, right? What's happening behind the scenes, and that's why I don't want to short it. We're seeing a lot of traditional players like Stripe, MasterCard, Visa are now starting to play in the stablecoin market. Because we have seen the benefits of it. You can transfer the dollars anywhere in the world with a cent in a fee, and the transfer happens immediately. What else can you do where this is feasible, except on these rails? So
what is your prediction about Bitcoin price? Because that's the one which is affecting everything, right?
Sorry?
So essentially, it's the Bitcoin crashing below certain key levels, which drove Saylor to sell his stuff and a margin call on his company. And my question is like, because a lot of ordinary simple investors were ushered into these things like iBit and all. And I was looking at the chart of iBit; it's approaching the price 2 years ago. So I don't know. This whole I think Bitcoin thing is kind of snowballing downwards, and I expect that it'll continue to go downward. No?
it's not the first time.
Since it was connected with the lay investors who are into EBIT, I think it's the first time.
Yeah, so like we are seeing a drawdown of 50%, right? So 50% drawdowns happened after 2022. I think is the first time we are seeing 50% drawdown, but that over the history of a Bitcoin, 50% drawdown has been pretty common stuff.
So what do those poor individual investors do who got EBIT in their portfolio?
You do
They were
what
put
you're
in there by the
supposed.
JP Morgan Wealth Management and all these other
My,
firms.
my question is still the same. The whole idea was 2 to 5% or not 2 to 5% of portfolio in these instruments, won't kill you. And if you have a asymmetric return, it will do much better for you in the long term if the bet works out. Keep it as a moonshot portfolio. Now, I have no sympathy for those retail investors who then say, okay, I'm going to lever up and I'm going to, put my mortgage, put my food bill on these instruments. Sorry, guys. When you look at it, even your fund manager, even JP Morgan's for a change, even ARKK Kathy would say that 2 to 5% is an allocation amount that you should have in these instruments, right? If you are doing 2 to 5%, yeah, you're done, sure. Are you dead? Absolutely not. So what I term as a asymmetric bets, this comes once in a while, and you should only take an asymmetric position, kind of a position. Hey, 2% or 5%, if it works out, you'll be able to retire. If it doesn't work out, max you lose is 5%. You are still having 95% of a portfolio. So this is an asymmetric bet. It is an asymmetric bet. At any point of a time, you should still be okay with this going to zero. Like I put this under my moonshot category. When I look at a portfolio, I have a growth portfolio, I have a core portfolio, and I have a moonshot portfolio. ARKB, IBIT, these are all in my moonshot portfolio. And make sure collectively your moonshot portfolio is not more than 5 to 10% of your overall portfolio. You'll still do okay. So for those retail investors who got in, yeah, you lose 2% of your portfolio. But that's a bet you have to take if you want to make 20x or 50x. Some bets work out, some bets don't work out. And it's too early to say that it hasn't worked out or for me, it was a 20-year time horizon, right? I'm only what, 5th year, 6th year. So I still have a long way to go. So now coming to hyperliquid, right? So what we are seeing on the crypto side is over years, there have been many DeFi exchanges come and gone. We saw Swap, Uniswap and SushiSwap, and then a lot of other. I haven't been very actively reading on this crypto, in the recent times, but there have been many these DeFi exchanges, right? So in between, Solana became very popular, and now the latest one is on Hyperliquid, wherein you can do 100,000 transactions per second, right? And now with the SEC being more favorable to tokenization as an economy, we could tokenize every asset, right? Tokenize a painting, a Mona Lisa painting, or Van Gogh painting, etc., and have others own some ownership tokens and become a part owner of the same of the painting that someone has, right? So overall, we are seeing a lot of push towards RWA tokenization, right? Real world asset tokenizations. And if that's the case, then we will need these exchanges wherein you could have those tokens trade at an extremely high speed using this blockchain and accessible 24/7 across the world. Why not? And now the bigger question, Sajin, that I have is, over the years, I've seen many such exchanges come and go. Every time it looks like that this is gonna stay, right? Uniswap is gonna stay forever, or SushiSwap is gonna stay forever. Then Solana came with them. Solana was super fast, and they say, okay, Solana gonna stay forever. Nobody talks about Solana nowadays, or Solana-based exchanges. Now the recent one is Hyperliquid is gonna stay forever. I don't know enough around will Hyperliquid be the one which will stay, or will it also go the way like many other exchanges or the technologies have gone in the past? Right? Today, it is the talk of the town. And in every moment, it saw it felt that I think this is the one which is going to be the winner. There could be more than one winners. And now with more favorable SEC, we start to see a lot of ETFs, not only the Bitcoin and Ethereum, but a lot of other assets also. So maybe there's some Hyperliquid ETF. Who knows? And right now, Hyperliquid coin may be the talk of the town. And then people now want to buy Hyperliquid ETF, HYPE. Like it's not in top 10. We're looking at HYPE. Oops. It's like 57 bucks. And yeah, it started this year at 25. It's like almost doubled. So here again, I've not looked at their white paper or the look into the tech to figure out what are they doing differently, and why they will have a more staying power than, let's say, some of the other blockchains that are in space. When it comes to many of these tech is one stuff, the adoption is also another one, right? You might have a great tech, but if people are not willing to and move over to your technology, then that's not gonna basically increase their adoption, and then slowly die its own natural death. Many of the old, and those who've been around this ecosystem, probably can recall some of the names like EOS was there. Probably, I don't know, like there were many tokens or the chains that I've seen over the years come and go. Bitcoin, Ethereum, these two have been on the top for many of those years. Solana used to be number 4 or 5, like after these USD, Solana used to be much higher. XRP used to be down in the drains. Now after the SEC, the case having withdrawn, XRP came back up. Stellar, 2017, 2018, Stellar used to be a big stuff. Zcash came back from dead. Cardano at some point of a time used to be number 5, now sitting as number 18. Monero, right? So some of these are called dino coins, right? The coins that used to be huge few years ago and are now, way below in the list. Now, will hype become dino? Only time will tell. I have no idea. But that doesn't, at any given part of a time, there's a hype, there's an asset, people want to buy it, money, capital will move towards it. I've not spent enough time to know, is hype the next big thing? Yeah, Sam, go ahead. I see your hand up.
About a decade ago, they were talking about how close the wires, a firm's wires was to ultra very fast internet. Do you know what I'm talking about?
I know. Have you read the book Flash Boys?
So why aren't they talking about it for the past 6 years?
No, what? No, they've been this whole, not just wires. They actually moved from wires to the microwave antennas. Read the book called Flash Boys from Michael Lewis, which basically is talks on this topic. Is a lot of these high frequency traders, hedge funds, try to locate their servers as close to exchanges as possible so that they can trade on a microsecond faster than the others, and maybe can do front running and all this. It's a great book.
Well, is it a big deal any longer? I don't hear about it.
No, it's still the idea is like, hey, if everyone has it, then no one has it, right? Now every hedge fund, every HFT firm is trying to do the same stuff, and slowly you will dissipate the moat or advantage that you had when you began with it. Right? Is it still happening? Sure. Now it has become a table stakes, right? If you're a HFT and you tell them, hey, you know what? I'm an HFT, I'm traded on New York Stock Exchange, but my servers are sitting in Chicago. Like, you won't even get a seat on the table for when you're raising funds, right? It has become a probably table stake that your server has to be somewhere in New York or New Jersey, or possibly sitting in the same rack, right? So the things that have become novel at the beginning slowly become table stakes. So, and nobody wants to talk about table stakes. So again, I don't know if that's the case, but I would suspect when these things are novel, whether it's the internet, whether it's your website, whether it's doing e-commerce, selling on website or on internet, or whether you start to use LLMs, these things will all slowly become a table stakes, and they will, no one wants to talk about that stuff. We move on to the new hot stuff. So anyway, I think that's what been causing concerns on the crypto side. The majority stuff is, hey, some institution money has moved out of those ETFs, and the Michael Saylor selling is like, guys, is there any long-term thesis on this one? And then we also saw Mark Cuban liquidated his Bitcoin holdings, and I think Paul Tudor Jones. So these are some of the early backers, and now they have sold some of their holdings. So the questions are, because is the story over? Is the story done? That's why don't follow any of them. If you had your own thesis, and if you think that the thesis is still valid, then you do. I mean, you stick to your thesis. Or if going through what Mark Cuban or Paul Tudor Jones has to say, and if your thesis change, take an action on it. All right. Okay, we'll move on to the. I think I'll need at least 15-20 minutes to talk about the concentrated stock positions. Let's park it for the next week, and maybe we can go through some of the individual companies and the earnings, etc. Because we're already hitting our 2-hour mark. Unless someone like, oh no, I really want to look at the options on how you can diversify without paying taxes. Because that content is not going to change tomorrow or the next week, right? Is the same stuff. What else do you want? What do you want to do? What do you want to talk about? We can talk about some specific companies and what happened this week, or the last week or. Wow, diversify. Come on, you're gonna talk about the earnings, nothing else? All right, so let's talk about how you can diversify. You guys are sitting on some big gains. Tell me, is it NVIDIA or SanDisk? Oh, I'm just kidding, guys. All right. And I first heard about this 2023 when one of my friend who's a CFO in a company, he was asking me, hey, do you know about this? I'm like, no, because I never was in that position. So he was the company that he was a CFO had done great. The stock market had done great in that company. And so obviously he was sitting on a lot of a concentrated position. So I thought, then for the first time I read it after that, I think it brought up in 2024 or 25, briefly touched upon that. But now you're seeing over the last year or so, we have had so much gains on some of these stocks. And if you are an employee of one of these companies, like let's say SanDisk, let's say KLAC or ASML, you might be sitting on heavy gains and might be scratching. What if the stock goes down? How do I protect myself, right? How do I diversify? So let's talk about how you can escape the concentrated wealth trap. Easiest stuff. No, let me first talk about why we're focusing on this one. Going back to our initial discussion, if you're concentration, if you were 100% tech, great. your portfolio has done great, but it also introduces a lot of risk in your portfolio, which became apparent on Friday that you're down like 5%. And God forbid, if you own some of these, big positions in some of these more volatile stock, you might be down 15, 20%, right? I can't tell. It depends on what exactly you own. So big fortunes are built on concentration, and they are also lost on it, right? So everyone has a time in the journey of building wealth when they want to start diversify it and make sure wealth preservation becomes an aspect, more important aspect than just trying to build it. Easiest way to diversify is that you just sell it. Right? No one is stopping you from selling it, except if you're working on, if you want to sell your company stock, you have a limited window in which you can sell it, right? Whenever the window opens, and that time you can sell it. But your manager is not stopping you to sell during that time. Whenever a window opens, sell your stock. But then you're get hit by this is the biggest blocker for anyone who has been in this situation is, I got an immediate 20% capital gains tax. Say you work in SanDisk, you got those SanDisk stocks assigned, or through ESPP or whichever way, you bought them at $20, $30, not too far away, right? In 2025, 2024, on all those $20, $50 has become $1,600. If you sell your stock now, you have to pay huge 20% of the gains to, or if it's a long term, let's bring a long term, 15% of the gains to your Uncle Sam. So you don't want to sell. Okay? So that's the biggest barrier. Otherwise, you can immediately sell it off and pay capital gains tax and sleep well. So what can you do if you don't want to sell? So there are a few strategies which we want to talk about. Okay. One is a call exchange fund. So last year I talked to Charles Schwab in their meeting. They didn't have it, and they told a lot of companies have it. Well, let's talk about what an exchange fund is. There are three strategies that I want to talk about. One is exchange fund, other is called Section 355 exchange, and the third one is the structured products, like you do long short products, which like Wall Street funds will be able to do it to generate tax losses, etc. So let's talk about the first one, which is called exchange fund. It's also known as swap fund. So basically, this is a private investment vehicle. You work with a company, Wall Street firm or a fund that actually offers this, and a lot of investors, they pool in money, they pool in their concentrated stock position to that fund. Say you worked on SanDisk, you have a SanDisk shares available, a lot of SanDisk shares available. Someone is an NVIDIA employee, they have a huge concentration position in NVIDIA. Someone is an Airbnb employee, or pick ever whatever stock, right? So all of you individually are sitting in hugely concentrated stock positions, but collectively you may be in a different sectors, right? Another person is an Airbnb stockholder. Another could be a Robinhood stockholder sitting in a concentrated position. So what these funds do is, each individual investors, they contribute their appreciated stock to this managed pool. Now this pool will have a lot of contributions from individual concentrated positions, but overall pool could become diversified. You get the point, right? And then you get an ownership stake in this overall pool. So you put in NVIDIA, and out you get a little bit of NVIDIA, a little bit of ASML, a little bit of Airbnb, a little bit of Robinhood, a little bit of JP Morgan, stuff like that. So now this is how, once you put in, you're not selling your stock, you're contributing to the pool, and then you've been assigned the units of that overall pool, which is a little more diversified units. This is how you diversify it, and you will only pay the taxes when you sell the units of that pool. But you got your diversification without selling your concentrated position. Now, there are some, it's not that SEC, or sorry, the IRS will make it easier. You have to have 7-year lock-in period. You cannot take your money out until 7 years. Number two is the pool should have at least 20% illiquid assets. So there are issuers who offer these things, and they have to abide by these restrictions that are being put in by IRS, right? So what's the advantage? You can defer all your taxes, and you get an immediately diversify a concentrated position without triggering capital gains tax, right? What are the pitfalls? Illiquidity. You have to hold it for 7 years. And if you think, oh my gosh, the market is up for 3 years, market is up continuously, maybe it will correct. In 7 years, maybe it will down 50%. Then you'll have to make a decision whether selling now and taking a tax hit is better, or you want to put in this diversified position and be available to use this money only after 7 years. So your money is locked in. Other thing you need to look at is, do you need this money before 7 years for paying your bills, right? Or some other heavy expenses. These also come with a high fee, right? So you have to run your calculations to see how much fee, and if you are paying fee year over year, is it really worth or not? And because you also have illiquid funds, you have a little lack of transparency. We have seen what is happening with these illiquid funds in this year, I would say last 12 months, right? All the private funds, private equity, private credit funds sitting in an illiquid real estate investments. Suddenly we figured out, okay, those are not great ones. But that's only 20%, minimum 20%. So you have to see those who are providing these funds, how much is the lockup period, how many illiquid, what kind of illiquid do they have, what's the fee and all that stuff. Then you have to decide whether it's good for you or not. I'm going to throw in some names, not recommendations. I have no idea what they do. I never had to go myself through this, but Morgan Stanley is big in this one. Goldman Sachs, they run some swap funds. Like I checked last year, I spoke to Schwab during their Santa Clara meeting. I said, do you have these things? They say they were planning to launch it by December. If you have a brokerage account with Schwab, check them. Do they have these swap funds or something called exchange funds available with them or not? I see this name Cash coming up. So they have a structured funds who basically will track NASDAQ or S&P, and you can start with $100,000 contributions in it. Some of them, like Goldman Sachs and Morgan Stanley, JP Morgan's of the house, might have a bigger minimum saying, hey, we only take if it is 500,000. Also, you have to see if those funds are open to accept the funds of your company or your concentrated position. You might be sitting with NVIDIA, but Morgan Stanley says, oh, I already have enough NVIDIA positions. We don't want to add into this pool because that will make it concentrated and it will lose the whole purpose of it. We are now looking for someone with the Berkshire Hathaway funds. Right? That doesn't help you. So that also the phase in which are there funds open to add more stocks of the concentrated positions that you hold in your portfolio. Right? So some timing also need to be taken care of. But this is one way you can explore in trying to get rid of your concentrated stock position and get a pooled, diversified funds, which you have to hold it for minimum 7 years. Okay. All right. Let's talk about the next one. Next one is a 351 exchange. So in a 351 exchange, there's a company which will create a new ETF itself. So this one was more on a partnership side. We all pool in our own individual concentrated positions, and then it become and then we all have a units of ownership of that pool of funds. This is a company actually start an exchange, but there are rules in which, like, if I have a concentrated portfolio, concentrated means, I mean, it's, again, I don't know how much it will be applicable if you have because of the IRS rules. So IRS suggests, they're saying no single ticker should be more than 25% of your portfolio, and no 5 tickers should collectively be more than 50% of your portfolio. If you have a portfolio which satisfies these two conditions, and you still want to diversify without selling and paying your taxes, you can do this 3-5-1 exchange. Or not you, because for you to do it, there's a lot of legal work and all that involved, but you can work with other issuers who do this work. But if I say, oh, come on, it's if the limit is at 25%, then I don't even want to talk about it because it doesn't serve me. That's a different question. Right? So in this case, what these fund those issuers do is they will bring all these stocks under an ETF wrapper. Right? And then once these stocks are under an ETF wrapper, then you first of all, you get a diversification, right? Of immediate diversification. Number two, the issuer, the manager of this ETF can start to generate, diversify it further by selling some of the concentrated position and buying, let's say, by selling some memory stocks, some of the stocks that are already hot, and buying some of the non-hot sectors like healthcare and financials. But because it is under the ETF structure, you don't have to pay any capital gains. You will only pay the capital gains when you sell the units of that ETF. Right? So this is the beauty of ETF structure because US market, you allow you to, create or redeem the new shares as an issuer. The end user, you don't pay the taxes. Mutual funds, you have to. That's why I don't like mutual funds. When it comes to the ETF, the manager can still make the portfolio less concentrated by selling some of the holdings and diversifying into other holdings, but you don't get hit by the capital gains. Right? So that's how it works. But then, as per the IAS rules, you cannot contribute a portfolio in which one single entity is more than 25% of your overall portfolio. So I guess that's the big limitation. Otherwise, there's not much of it's you get, since you're under the ETF wrapper, there's no, I would say, big gotchas around it. Of course, you have to work with the manager who you think talks sense, and they're going to diversify and still make sure they're diversifying into the sector, which probably will outperform, right? Diversification for the sake of diversification is not great. It should not that I want to diversify out of semiconductor and NVIDIA and end up buying a business, which is pathetic, or end up buying a falling knife. So there are some firms who run this. Poland Capital, they run 350 one exchange pipeline. Cambria Investments, Matt Faber, they open up the window when there was 351 ETF conversions. BNY Mellon does this. Again, no recommendations. I just asked Google, tell me, at least 3 examples so that you can go and then start explore if you are in this situation, right? You have to finally decide. There may be more, but this is another one of how you can diversify without selling. Third one, which is even more complex, is getting into structured products. Now, this is where the whole of the Wall Street machinery will come into picture. They run the quants models to figure out, to basically generate tax loss harvesting for you. So the way that works is, let's say you contribute, you transfer your $1 million of a concentrated stock position to a separately managed account that these quant firm runs. Okay, so it's a separate account. You gave $1 million. Like what manager, he won't sell it. So he or she basically they'll use your concentrated portfolio to take margin, 30% margin on it, and buy some of the other stocks, not the one that you contributed, but will buy some diversified, highly attractive liquid long positions. On the other hand, simultaneously, they will also borrow and short sell an equal amount of dollars, right? So 30% margin they took $300,000 got a long positions in it. And then did a short positions of equivalent $300,000 amount. So your net exposure in terms of from a market perspective still come back to $1 million. But now they are playing on the both sides of the market, long as well as short. One thing is gonna lose. Right? Market can't be on the both sides, right? Either market goes up or goes down. At the same point of time, it can't go up or down. So depending on if the market has gone down, they can then generate losses on your long positions, do a capital tax loss harvesting while rolling off your short positions. If the market goes higher, you can realize the gains on your basically losses on your short positions, do a tax loss harvesting, right? And then there are some rules of IRS, what you can do, what you cannot do. And then there are strategies that they have in order, hey, I closed out my this short position, took a loss on it, but it means I became net long. So then you have to buy, or you have to add more short positions. But if you can't add the same one, because the 30-day wash rule will kick in. So these quant firms have the models of, okay, let me buy these equivalent others which will not invoke the wash sale rule, but I'll still have the 30% short position, which I close it to do the tax loss harvesting. More complicated, difficult to understand. Mostly some of these quant funds, hedge funds will run these strategies, run the structured product for you. You have to reach out to them to know what exactly stuff they do. Okay. And then there, like I said, there are some limitations. The biggest risk is a counterparty risk. What if the counterparty is not great in doing it? Now there are some IRS rules. What if you fall off that rules and you're not able to recognize all the tax loss harvesting? So the manager selection and the ability of manager to navigate all these things is very important. And you'll also have a lack of liquidity because some of these products will not have any secondary market. And let's say you give it in the money and they have exposure to structured product, and then you say, okay, I don't like this fund manager. 2 years later, you say, you know what, I want to fire it and take my money out. Now there are some IRS rules on, even if you held it for 2 years, some short position will still qualify as short-term gains and losses. So there is a lot more complexity in that one. Number two, there's a higher fee to be paid. Remember, you are shorting stock, right? Most popular is 130. So you're building 30% short positions. In those short positions, if there's a dividend comes up, you are liable to pay the dividend. There is a borrowing cost for it. If some of those stocks become too hard to borrow, the borrowing cost jumps way higher. So this is a very expensive way to do it, but it is a way to diversify your concentrated positions, right? So some of these, I think AQR, they run these things. Do I have a list? Yeah, there are some funds. Some of these quant funds, they will run these structured products for you, long short position. I think they call it as TSL, tax or TALS, tax aware long short products. And you can read more about it. But this is another way in which you will continue to generate tax losses so that eventually when you sell your holdings, those tax losses will offset the tax gains that you may have because of your selling of your holdings. So that's how it works. Okay. All right. So overall, if you were to, put it in a single slide, this is how it works. Exchange fund, which is everyone pool their stocks together. You have a 7-year minimum lock-in period. So have to have a long-term outlook because you have to lock in for 7 years anyway. 351 exchange, you need to already have a diversified portfolio, 20-50 rule. And if that disqualifies for you because you have a more than 25% of your portfolio in a single stock, it's a no-go for you guys. Or long short structured products, they are again restricted. You cannot abruptly exit it. You have to stay with that fund manager for much longer time. And because it's depend on the specialized skill of that fund guy who's running it, and also like if that firm goes out of a business, you might be in for surprises. So there's a lot of a counterparty risk, and of course the higher fee, because no one will do this work for free. More the complexity, higher will be the fee. So that's how you should evaluate. Go and research more on this one. I never had to do it because I don't have any stock that which is in this situation, but you may be, and there are ways to diversify it. Earlier in my career, I sold of my concentrated stock position because my portfolio was very small, and then I had a company stock which was giving me sleepless night. I had no idea about this, all these things. I'm talking about more than 5-6 years ago, and the stupid mistake I did was to sell and pay capital gains tax. You don't do that stupid mistake. Now we know. I wish I would have gone through this like many years ago, but it's
Do you
never
know about,
to learn a new thing.
so there is this thing called zero cost collar, zero hedge. Have you heard of that for
I
this
mean,
same?
so that's what I do on my portfolio, right? So basically, you can do a zero cost insurance, but then you're capping your upside. So what the zero cost collar is, you hold an Nvidia stock. Let's say Nvidia is sitting at $200 right now, but that does not save the taxes. The zero cost collar is Nvidia is whatever $200. You sell a call on Nvidia, let's say at 215, and then use that premium to buy a put on Nvidia at whatever price. Basically use the same premium to buy a put. So now you have this is called a collar position, buying a put and selling a call. You could do it at the money, right? Instead of going to 215, maybe you could do it at 200 itself. And if the market doesn't have too much of a skew in terms of the call and put pricing, you probably don't pay anything out of a pocket. But what it does for you is to protect your portfolio in case Nvidia goes low, right? Because you bought a put at $200, Nvidia goes low, you can always sell it at $200. But if Nvidia goes higher, then at $200, your call is going to get called away. In that case, like say I have done many times, is I'll take a loss on the option side, do a tax loss harvesting on the option side, and if I still want to hold the stock, let the stock continue to hold it and let it go higher. But yeah, this, I mean, I use it, but this is what essentially the collar is. That you buy a put, sponsored by selling a call on the same position, essentially putting a collar around the current stock position. That's what the name is.
Mm-hmm. Yeah, I don't know why it is advocated in these ultra concentrated stock positions of startup companies. I guess maybe it's because of that. Like when they go public, they can capture the high price. Say SpaceX goes at 135, the employees inside it can kind of do these collars. Is that the reason? Probably to keep.
So you're talking of the other. So I thought the question was around, I own a lot of stock and I have a concentrated position. Can I put a collar around to protect it? So that's what I was explaining. The other thing would be that, hey, I don't want to put a lot of capital right now in buying this stock. And can I if the stock continues to go higher, which I expect after IPO will go higher, if I buy a call, then I have to put in the premium money, right?
No. I was referring to this. The problem you're posing right now, you're showing on your screen,
Okay.
is one of a highly concentrated stock position, right?
Yeah. So
Of
in
a
that
person
case,
who's working at a company, which is possibly a startup. If it's a startup like SpaceX, they cannot execute public trades on puts and calls, but somehow these, I guess, people they come up with ways for them to execute that. And I think what you're saying is it's not for tax reasons, but rather for capturing the price, like 135, right?
or protecting your gains. So again, I think that the Wall Street firms can create these structured products for you or the swap products for you.
Yeah.
And like you and I can't do it because the options are not listed. But you go to the firm, and then that you have your counterparty risk, right? Goldman Sachs will say, okay, I will, pay you whatever X amount. I will basically mimic and you have to have a faith on the Goldman Sachs that they will come true on whatever they have promised you, right? And Wall Street does this all the time. And many times we have seen even some of these ETFs, when you say, hey, how is this ETF giving me 2x or what are these returns? Majority of the time they will have a contract with some of these Wall Street firms, and these are just the swap contracts. These are not that they are really actually trading in an options market. These are not OCC backed or OCC protected contracts. Some of these may be just a swap contracts with the Wall Street firm, which will say, I'll give you the money of 2x, right? And I mean, it's a pretty common way. So if you are a startup owner, some firm in Wall Street may be able to give you those contracts and say, okay, we'll mimic the behavior of as if you put a collar around your position and protect your position and
Yeah,
the similar behavior.
I bet employees at SpaceX have been doing this in the last 3 months. Cost collars.
Yeah, possible. But then you will, if a space has become double, you will lose that upside.
That's right.
There is no free lunch. You know there is no free lunch. If you protect your downside, you have to give up something. Right? Either you give up upfront cost or you give up the future upside. Something you have to give.
So Salomon Smith Barney was approaching us as employees in year 2000 when our company was about to go public.
Yeah, there are so many things happen in Wall Street. I have no idea what all the stuff they do. But I am only look at, okay, what as an investor, me as an individual investor, what can I do? Right? So some of these stuff, you can put a collar individually, but then the options
But
have
in
to
terms of taxes, I think the best strategy is to sell the stock outright, honestly.
I mean, the problem if you sell the stock outright, the 20, whatever, depending along, let's say even if a long-term capital gains, the 15% of the money is gone directly to Uncle Sam, which you
Right,
could
but
have deployed for a better purposes. In that compounding is gone.
they say tax tail should not wag the other dog, right?
That is true. Yeah. Anyway, so that was I thought I'll talk about it because many of us may be sitting on, especially those still working in one of these big companies whose stocks are done wonderful, and now you're looking at 50%, 60%, 70% of your net worth is tied in your company stock, which have appreciated great. How can you take some risk off the table? Selling works for you, go ahead and do it. But there are other ways also apart from selling. I thought I'll cover that. All right, that's it I had for today. What else we want to talk about? I'll open to the breakout rooms if you want to talk about something else.